Well, good afternoon, everybody, and welcome back to Bull Sessions. This will be our May 16th, 2023. Happy Mother's Day to those of you from the trailing weekend. We can never say thank you to moms enough, so we continue to do that. My name is Mark Robertson. I am joined here by my dear friend, Ken Kavula, and we have sun shining in Michigan today.
It's a beautiful day out there, and it was yesterday too, for that matter. A little bit cold yesterday, but still just a gorgeous day. My wife is out planting flowers all over the place. I'm kind of interested to finish up here and go out and see what they look like. So let's move this thing forward here,
So
Mark,
she's
okay?
she's once again spending my inheritance on weeds.
On flowers, yeah, on weeds. Not on weeds. They're beautiful. They're
All
gorgeous.
right. All right. My dad said they were weeds, so I stick with it. We're also joined here by Matt Spielman in the back room. So, Matt, I suspect the sun might be shining and it might be a little warmer in Houston.
Yeah, Texas concurs. Sunny day today.
Very cool. All right. So, I think we're going to have a lot of fun here today. We ended up in kind of an interesting place, delving into the holdings of I think it's Polen Small Company Growth Fund, and just an interesting area to discover ideas. I've actually gotten a number of inquiries lately saying, why don't you talk a little bit more about some of your more unusual places to find ideas to study? And this is one that Ken and I have favored for a long time. And as you were saying before, Ken, this is not a fund that either of us were familiar with.
Yeah, and that's saying a lot because you go through a lot of funds and I go through a fair number. So to find one that's completely unknown and that has some good ideas in it, that's a double. What do you call that? A not a trifecta because it's only two. I don't know what it's called, but I'm
That would be,
appreciating it.
I guess, a daily double.
A daily double. Okay, there you go.
All right. And many of the companies involved with some of the companies we will be talking about are shown right there on your screen. So let's go ahead and get underway. Oh yeah, we have our Portillo's moment. That's me with the North Florida group. And again, this is not here for any other reason to point out that Portillo's is not sponsoring today's webcast, but they should be. All right, no investment recommendation is intended. We will appreciate if you go out as Portillo's shareholders and actually visit one of their restaurants. But no, this is all about education. It's about illustrating some principles, methods, and techniques of the modern investment club movement. So you'll hear our opinions about those disciplines and methods. Please do your own homework before making any investment decision. And if we own something, we'll try to admit that. A week from today will be our May roundtable. That's a week earlier than usual, so make a special note of that. We will have the last Tuesday of the month off for Memorial Day, so we're going to do it a week early. So 7 days from now, our monthly roundtable. And we've been doing that since 2010. We have decent, better than decent, better than good operating results, performance results for the roundtable. Come and check it out as 3 or 4 of us will share our best ideas for study during that session. If you want to be added to a reminder for those monthly webcasts, send an email to nkavula1@comcast.net. And if you have anything else on your mind or suggestions for future topics, our 2 email addresses are down there at the bottom. Anything else, Ken?
Nope, you covered it nicely, Mark. Let's get a move on it here.
Let's roll. All right. Well, here's our traditional chart. I did put an extra one in there for a little bit of color this week. Again, we look at the one on the left as a characterization of the stock market. The green bars are the stock market as represented by the value line arithmetic average. That's basically the average of the 1,700 companies in the standard edition with a price index that's formed from all of them. The red line and dots are the return forecasts. If you averaged all the companies in the standard edition, that's what you would see. Right now we're sitting at about 13%, fairly decent level compared to some of the lower levels down here. And the green bars are slightly below the blue line, so we believe that ultimately the green bars follow that blue line of reasonable expectations. Now, the reason I put this one in here, it's a busy chart on the right. I understand it gives some people headaches. It really is kind of a fascinating look at the stock market over time. And what it represents is the green and the, I guess that's kind of maroon, depending on what angle your screen is at, Ken. Is that brown or maroon? Or
It's kind of red to me, Mark, but
it's
it's
kind of
okay.
red today. Okay, that's a good. Then you've got a good angle on this.
Yeah.
Literally, it's the taking a look at the U.S. stock market. I think it's the New York Stock Exchange, and just charting the number of new highs minus the number of new lows. So when it's low, obviously there are more companies making new 52-week lows versus new highs. And the reason it comes in kind of interesting, and it's just something that we note over time, is that every time it dips down, and we actually follow this blue trend line that's weaving through all of this, anytime that drops below zero, you basically have a challenging moment in the stock market. For people that are not near their life expectancy or not in the end of their senior years, that is simply an opportunity. This was an opportunity back in 2008, 2009, believe it or not. As ugly as it was, that's the worst moment in the stock market history in terms of return performance. And what I kind of wanted to point out is, that resulted in this really nasty V-shaped downward move in the market back in 2008, 2009. Well, lo and behold, if you look at the characteristic here on the right-hand side, we're kind of in an equally challenging moment with respect to this new highs versus new lows indicator. And the fascinating thing is that this has not dropped down nearly as much. And it kind of goes with this statement down here. There's some stimulation and support for the market, and that also coincides with this picture over here also. This is what Ben was basically talking about. The prices were too high for too long. So what I kind of find fascinating is that the market hasn't dropped further than it has, or with a deeper drop, and maybe that portends challenging days ahead. But we are in a moment, without a doubt, in the market, and a lot of people are coming up with recessionary talk and reasons to be bearish. I think we should come up with a optimism vaccine, Ken, that we can send out.
Well, I just appreciate the fact that that blue line is headed in an upward direction right now, Mark.
It is.
I'm talking
Hopefully it'll
about
stay
the
that
blue
way.
line on the right-hand side.
Right.
Yeah,
He's talking about right here.
yeah.
This
And it just very, very happy that it's moving in that direction. And I just wish that the movement was a little broader than it's been in the last 3 or 4 weeks. It seems that we have a not that many stocks kind of carrying the market right at the moment, and I'd love to see the momentum widen a little bit more, but I'll take what I'm getting right now.
Yeah, in that spirit, Ken, I think that the number of, like you said, a number of the Russell 2000s, we're going to talk about that in a minute. Russell 2000 smaller companies are definitely languishing or lagging, and I think that might be pumping up that negative number a little bit right now, a little more than usual. So, again, the only reason well, not the only reason, I have used this in the past with people that were kind of concerned about the market. And you may remember we had moments in 2012 and 14 and 16, 17, 18 where there was recessionary talk and problems. And working with friends and family members, I basically pointed out the strength of this picture right here and encouraged everybody to stay fully invested, even after we elected a fairly unusual presidential candidate in that time frame. So it was an interesting moment in time, and I did use this graphic to actually defend. We're going to probably be okay. There's no way to know. But anyhow, I just thought that might be a little bit extra amplitude. Maybe we'll put a couple slides like that up from time to time in tandem with our favorite chart there on the left.
Mark, there's no exceptions to companies in this graphic. Am I right? It just takes all of the companies that are listed on the exchange?
The one on the right? Yeah, it's
Yeah,
all
it's just
yeah,
all of them,
it's
right?
all of them.
So it would be taking financial companies as well as normal industrial companies
It
then, right?
it definitely would. It might leave out some of
Okay.
the closed-end funds and stuff like that.
Okay.
All right. Just a little more fodder for discussion. I think this was kind of interesting because we do believe in the magazine cover jinx. And if you believe in the magazine cover jinx, maybe, and if you hold your nose and throw some salt over your shoulder and click your heels together 3 times, maybe it makes sense to, I can't even say the words, Ken. Uh, go shopping for some Chinese stocks. I don't know. We have been burned in the past a little bit by phantom companies and that sort of thing, but we do want to take a little bit closer look at that. Are you ready yet, Ken? Is it?
I'm not ready at all, Mark, and I'll tell you why. It's not so much that I can't put my faith in the numbers that are coming from the company. I can't put my faith even in the pictures that are coming from the company sometimes. But I was taken aback to such an extent as I watched the government just turn on a dime almost within the last year and go from supporting some of their most profitable companies to it seems like they were putting them in a timeout or punishing them for being successful.
Mm-hmm.
And it just happened almost overnight, and the stock prices plunged, and there was a shakeup in the leadership of some of the largest companies, and a shakeup in the way they did business, the way they organized their business, and everything. It just is too centralized for my taste. I mean, I'd rather see an awful lot of people mess up individually than have one person mess up everybody collectively. And that's what I think is happening to a great extent in China on a fairly regular basis.
Yeah, the rule of law question and everything else is definitely there. The phantom companies, we did that. We mentioned that documentary on some of the Chinese policies a year and a half ago on the broadcast. I get all that. I guess what I would say to all of that is if you do consider doing this and investing in a Chinese company, just make sure that the percentage is appropriate in your portfolio. I have been tempted from time to time. There are a few groundhogs that have Alibaba in their portfolios. Um, it's not real common, especially since, as you said, we have been burned a couple times by companies over there. So anyhow, all right. Well, the graph on the right is also pretty interesting and pretty out of kilter. What you're looking at there, the blue line is the University of Michigan consumer sentiment, which is down near all-time lows. If you look kind of across the bottom down here, this is the blue line is all the way down there. Typically, that does result in a reduction in the equity positions, people going to cash or other type investments, and that's not happening right now. And again, it's all kind of part of that stimulus and pumping up question that we have talked about a bit. But that's as big of a spread, as big of a disconnect as we have seen in, well, as this shows right here, 35 years.
Mark, does that horizontal at 90 there have any meaning to it, or is that just there to help you read the where the different things are on the graph?
I'm not sure. Matt, do you have any input on that? I know you watch this stuff a little bit.
No, I don't know. I mean, it looks like it's some kind of an index, but I have no idea what 90 designates.
I'm guessing that maybe it's a median of that orange. Just guessing.
Okay.
But anyhow, it's as big a disconnect as we've seen in quite some time. And there's our Pulitzer quote. All right.
I'm gonna suggest also, Mark, that I think people are getting a little bit more savvy as they deal with pollsters, and I'm not sure that people anymore are being as honest with pollsters as pollsters would like to believe they're being. I think this is a great example of maybe people telling the pollster one thing and then moving in reverse and doing something completely different.
Well, that's
I
a
mean,
really good segue to this slide.
yeah, we've really seen a lot of that going on in political polling, and
Yeah.
perhaps it's starting to leak over into other kind of polling as well.
Well, I'm serious. That's kind of a segue. Matt had actually made a comment about this in one of the forum posts, but um, Michael Burry we talked about last week, and this further identifies him in the movie The Big Short. Well, he was basically in a run for the hills, sell everything mode on Twitter back in January. And 45 days after the end of the first quarter, we actually get to see what they're actually doing with their 13F holdings as of March 31st. That's the date that you see here. This is courtesy of Insider Monkey. And lo and behold, well, first of all, there's two Chinese companies, which fits with the previous slide. But look at the banks. And notice all of these words that say new here. That means they're new, first quarter investments. And there's just a whole bunch of banks, including our friends here, Western Alliance. Just kind of interesting.
Well, and a significant amount. Now, this portfolio, the portfolio percentage, and this was really tough to get numbers. So he's got just more than 100 million in publicly traded companies. He's got a lot more in private companies.
Right.
So it's a fraction of his, but I mean, this is still 17% of his portfolio total, and he does have a high portfolio turnover too.
Mm-hmm.
But right into banks, and I just updated this morning. I took it compared to the chart you shared last week, his Twitter chart of where he was mapping out roughly bank risk, and he, I mean, this includes First Republic, right? So he was playing, on the front lines and even over the front lines. That's a smaller percentage, right? It's 2% into
Mm-hmm.
First Republic and 7% into New York Community Bank Corp, right? So he's got weighted bets in there. But he definitely saw action there. Let's say at least that.
Yeah, and I took advantage of a couple of those swoons in Western Alliance. I continue to see decent results. They could be lying to us. I don't think so.
Well, there's been a big deal about this on CNBC, Mark, where they're continually making the point that these could have been extremely short-term holdings. None of these have to be in the portfolio at this particular moment, because this is all backward looking, and it's looking back, a fair amount of days.
6 weeks.
And
Yeah.
and there's a lot of movement in these hedge funds many times where they're taking a position and then reversing that position very quickly. So the conclusions that were being drawn was that you can't really draw any conclusions from it until you begin to see if any of these banks are continue to be held in the portfolio.
Yeah, from quarter to quarter.
The other thing, Ken, knowing that Michael tends to be bearish, right? His handle is Cassandra. I couldn't tell, and I didn't look at the 13F directly. I couldn't tell if these were necessarily long or short.
Yeah, and you can only tell with the puts and calls on some of the portfolios that are showing.
Well, I can answer that, Matt. These reports only report longs.
Okay.
The report doesn't report short positions at all.
Mm-hmm.
Okay.
Yeah,
and I only picked that up as one of the comments that was made by one of the panelists a couple days ago, that the reports of holdings are only long positions because that's all that they're required to divulge.
Right, and the exception to that would be looking at a Citadel, for example. They will display their puts, and which is basically in most cases a bet against. So they're there, but you're right, Ken. The short positions are not shown. And the other interesting thing is up at the top there, Jim Simons, who has probably one of the highest return on investments of anything out there at Renaissance Technologies. His team there, not a single bank in their top 100. Now again, they have a frantic turnover rate. So I mean, this particular report, as Matt and Ken are both pointing out, when you look at it for Renaissance Technologies, they change their holdings between breakfast and lunch. So keep that in mind. And then of course, the other thing is just checking in on, well, what kind of a track record does Michael have? It's actually not bad, as you see down here at the bottom. That's actually pretty good. But very, very active, very high turnover rate. All right. Just for fun, those top two positions that you see here that were relatively new in the first quarter, that's a pretty good chunk. It's 20% of this particular investment, this particular asset management fund, and you see $20 billion there. So two Chinese companies. This one's JD.com, again, an e-commerce platform in China. This one would make me a little bit skittish. The profit margins are a little bit lower. You can see the 3% here. It's kind of been all over, a little bit of a camel for a quality indication there. Earnings have been a little bit erratic. The one thing that is a bit attractive is it's down fairly close to its 52-week low. It's been on quite a flat spot. And I would draw your attention to that picture of the golden dragon on that magazine cover. That would fit pretty good right here. And is it going up or is it going down or staying the same? That's the question mark. I actually like this one a lot better. And there, like I said, there are several groundhogs that are in this one. Similar type company, but again, in terms of e-commerce and that sort of thing, but higher quality, higher return forecasts. They did just lose. How long ago did they change over executive management, Ken?
Yeah, within the last year, I think, Mark, but maybe
so
even within the last
year.
6 months.
And you kind of have that same pattern here of the golden dragon from the Economist cover. And that's kind of what they're talking about. And again, the question being, will these guys continue north? Now, the Economist article goes into a number of demographic challenges with the population aging, and they actually have a shrinking workforce in China for the first time ever. I mean, it's not shrinking, but it's growing slower than it had been in the last couple of decades. So there are things that work, and notice the flat earnings curve here. I don't know. I'm not ready to go back
Mark,
to China either.
hasn't there also been a lot of dispute off and on since Alibaba came to the market about what it is you're actually buying when you purchase Alibaba in the United States?
I can't speak specifically to it, but yes, I'm aware that there has been.
I don't know if I can go into much detail on it, but I think that you'd probably want to explore and find out what it is. I don't think they're traditional ADRs that you're purchasing when you're buying into Alibaba. Matt, do you know anything about that?
No, I don't.
I will take a closer look at that. And I've been tempted to go back, and I don't remember the name of the documentary from a year and a half ago, but we did cover this, and right down to the guy who bought the condo across the street so he could count the number of trucks going in and out of a factory, and basically demonstrated that it was also another one of those fictitious companies. I'm not for a moment saying that Alibaba is that, but there is an issue of trust, and I'll just leave it at that. It's not something that we're that accustomed to worrying about that much. All right. All right, here's our update. Matt, you're continuing to lead. Congrats.
Thank you. I'm
Pretty
trying
good
not to let
performance
it go to my head. That's a long way to go still.
I do want to, maybe I'll do it for next week, because I wanted to put up from a previous year when we had people with like 3 million and 2 million in the balance and 49% average returns, just so we can, relive that moment for once. Now, Ken, you are making a hard charge.
I know. I'm on my white cavalry horse, and we're moving to the front now. So I ho's over.
You don't want to peak too soon. We'll get to that last day and have a duel or something.
I've already been through that before. I can deal with that. So.
All right. So again, normal cast of characters. Bob Shaw is up in the $1 million club. Kimmel's going crazy out there in Kansas with Plymouth. Defending champion Space Coast at number 26. they are lurking, and I consider them dangerous. So we'll see. The monkey
I'm
still,
shouting out to my buddy Herb there. Herb, notice who's at 30 and who's at 34, Herb, okay?
yeah, and Herb is equally dangerous on that stallion, the hard charge. All right, Kathy Wood continues at 101st. She did move up a little bit, and the monkey's still at 130th, so we rest easier. All right, here's something we haven't done for a while, and just wanted to say I'm fascinated by the portfolio. This is Matt's current dashboard. I like it. There's some real innovation and some stuff going on there, but it's
Yeah,
behaving
it's not
quite.
entirely reaching for the sky. And I will say I do not have an enviable track record because I keep my old groundhogs up too and watch after them. But um, the one thing that's different this time, two things are different. One thing that's different this time, um, most of these, Shockwave and Adobe were, I'll say, opportunistic things that came up last fall when Adobe crashed after the announced acquisition, and then Shockwave I just discovered. But most of these are things Victory I've had for 2 years. Most of these, and all of these are in my portfolio because I do believe in sort of in that. You know, I have enough companies to keep track of in my portfolio. I don't need to go searching for more. If they're good, I'd get them. But most of these I've owned for 3 years or more. So these are not necessarily the freshest ideas or the things that I'm most excited with, but they're things that I think, and it's not my whole portfolio either, but it's things that I think are right timing. And I think that's part of the success is I wasn't really reaching for the exciting ones necessarily. It's ones I've been quite comfortable with. And for the early months, I think for 2 months, my three laggards were the three high quality stocks I had, which was funny.
Mm-hmm.
And I was very happy because CRISPR, until a month ago, the par was actually negative 50%, 50%. And I knew I certainly disagreed with that. But, you know, and it's just a funny thing where CRISPR is not earning money yet, does not have earnings. So it was the point of where its earnings crossover point gets to, and then as data goes on. But it was kind of funny because if you compound negative 50%, you're down about 3%. like it was almost bankrupt. So yeah, I'm happy with it. I mean, it's a little reaching. Of course, Ardelyx is there. But you know, I've got, and it just was where those companies were. It wasn't anything like, given this market, I think we really should go for healthcare or biotech or something. I had 3 shots rather than Ardelyx's 1 shot at FDA approval and then either a buyout offer or just prosperity. I have 3 shots at it.
Yeah.
And it wasn't a big design. That was who I had. Those are the players on the bench.
Yeah, and I will
It's
tell you,
interesting, Matt. Go on, Mark.
I was just going to say, when we were selecting our best small companies back in October, I literally was sitting with Shockwave Medical in my left hand and Semler Scientific in my right, and I wish I'd have gone left.
Matt,
down
it's
a bit.
interesting that you've pulled from your own portfolio, and it gives me an idea of what your portfolio looks like compared to mine. I always go to my IRA and just pull the 6 or 7 highest par stocks and enter them as my entry, and mine are so much more speculative
Unexciting.
than
Go ahead.
yours are, unexciting than yours are. Mine tend to do pretty well, but there's so much unexcitement going on. I have 2 of these on my, boy, I wish I had enough courage to buy them, but so far I haven't been able to bring up the courage. It's CRISPR and Green Brick. I haven't had courage to buy either one of them. Looks like I should have, huh?
Well, I'll try and keep my head within my normal hat size, but needless to say, I'm quite thrilled with Green Brick, having kind of pounded the table that for a few years, and I mean, you know, it's kind of interesting to see the home builders diverge. I know we're going to talk about that a little bit later, It certainly is not alone in prospering, but it is definitely mining a rich vein right now.
Absolutely. Absolutely. And
All right,
you
so
compare it to some of the smaller home builders that have moved the other way and haven't seemed to move back at all yet. Very, very different paths to where they got to from where they were to today. Yeah.
well, a couple of months ago we speculated about the longer term perspective for the housing market and kind of scratching our heads, wondering why aren't companies like Green Brick doing better? And Ben Carlson came out with this last week, and I just thought it kind of continues the conversation of things aren't as messed up as I think sometimes it's made to seem on the nightly news. And this is a telling chart that basically says the vast majority of people out there have 30-year fixeds, and they're in a pretty good place. And I think that comes as a surprise to many people, especially considering the headlines and all of the hand wringing that we see virtually every day about this subject. And then this one is just astounding to me. I happen to be one of those in the blue chart. I'm hoping to get to green in the not too distant future. But
Yeah, we talked about this a little in the green room. I'm kind of surprised. We had surmised that we thought blue should be bigger because people tend to cash out when they refinance or something like that. But I'm almost surprised that some of the more savvy financial people I know purposely want to cash out because that's 2% money,
right,
and they can go reinvest that for 30 years. So I'm kind of even surprised about that. But that 38.7%, I was looking it up, and of course, not everyone in the population of the U.S. has a mortgage. These aren't quite exactly the same years.
mm-hmm.
But if you go the total population distribution in the U.S., which should actually be overrepresented, this would be, so baby boomers are, and this is in 2022, baby boomers are 20.58%, Gen X is 19.61%. That's almost those entire two generations.
Mm-hmm.
This is only ammunition, Mark, for what we've talked about a number of times in the last 6 months when it comes to inflation as well. I'm just not certain that the inflation reads that come down from the government take into account that we have this many people that own their home free and clear. Home ownership is, or where you live is a big deal with how much inflation you're experiencing. And whether you live in an apartment versus a home and all that kind of stuff. And if you got 40% of the people that actually own it, I'm thinking that they're missing a pretty big chunk of the inflation that's gone on year to year. It has to be factored in some way, and I'm wondering if it's factored in enough.
I would agree with that. I think that it's another one of those um, two-ended swords or whatever you want to call it. I mean, some people are really getting hammered. When the price of gasoline goes up as it has, it definitely affects others more. And I think that's pretty much all across the board. The last slide that we have here is just that reminder, and Matt gave a reminder of this just a few months ago when we were talking about if you're going to invest in one of these home builders, you want to find an excellently managed company, but then also pay attention to their field of opportunity and his reminder that, yes, all real estate is local. And I think that if you factor that into the decision, it can make a big difference.
Yeah, and there was just an update for March. I hadn't posted it, but when you look at the change in price, there's a lot being made. And because, here, when you just look at prices, it's pretty easy to guess. Coastal areas high, middle of the country lower. But the change in price is an east-west thing. So the largest, the easternmost large metro with a price decline in March was Austin, Texas, which was the only place in Texas. And basically all the declines are west of that, and everywhere east of that is still increasing. Now that's increasing on a 12-month basis. So the increase is declining, meaning it might be down month to month, but it's still above the westernmost. But there's also a east-west divide, which is not typical.
Natalie and I are hooked on these home improvement shows that are on TV, and there's one show based in Bentonville, Arkansas, and another one based in Laurel, Mississippi. And 3 times now in the last 6 months, they've been redoing homes for people that were able to work in California, but were not able to retire in California. So that just bears out what you're talking about. I'm not certain that I'd want to trade the ocean for Bentonville, but evidently there are a couple of people that want to do that. So
Arkansas was actually featured as a pretty desirable place to retire in a number of articles last year. Okay. All right. Just checking in real quickly on our small companies before we switch to our small company mutual fund. Things are kind of settling down a little bit. We actually have gained on the market in the last week and managed to stay ahead of the Russell 2000 growth. And we're just hoping for those banks to stabilize, and some of our selections there up at the top, let's hope they stay strong. Anything you want to add, Ken, or anything we need to dig
well, you got to
into?
turn that Portillo's green again, Mark. You know, you got to talk it up a little bit. Put more pictures of hot dogs in between the slides here, okay?
I think Wendy and I will be stopping in Portillo's in Chicago, so we'll be doing our part. So.
Well, Wendy's not going to eat enough to change the profit. Come on.
Hey, those salads are not cheap.
All right.
All right, so let's talk about a small company investor that we're just meeting for the first time. This individual's actually been running this particular fund for the last 4 or 5 years, I believe, roughly, and it's something that we like to do, and we've explained this in a number of classes where we take an accomplished fund, and our favorite small company fund is Brown Capital Small Company, and this is the only other one that I know of that uses the phrase small company besides Brown. Again, we are constantly reminding that small cap and small company are not necessarily the same thing. And it's kind of refreshing to run into somebody at least attaching that label to their fund. She's had a tough 1-year period that's kind of caused this. A little bit of Kathy Wood-ism, probably, at least for a year, but the longer-term track record actually isn't too bad. And the thing I point to here, Ken, correct me if I'm wrong, but I mean, we're seeing companies here on this list, purchased over the last several years that have appeared in our favorites quite a bit. So it just demonstrates that even independent of the performance of the fund, she is actually discovering ideas that we have liked. So again, we probably eat similar breakfasts. Your thoughts, sir?
Well, I'm going to interpret something for one of our audience members. I don't think that share change column means value of the shares. I think it's referring to number of shares and how that's changed since the bought date up to the present time. Am I right, Mark?
That is correct. This would be change in the size of the position here. This would be
Right.
the 1-year performance on the far right.
Yeah, so Five Below has 24% fewer shares now than it did when they bought it in May 31st, 22. But the 1-year return is 41%, and that's positive. So you have to kind of get those two ideas. One is number of shares, and then the other return is value of the shares they hold.
Right. And so what we're looking for here is we go to this column, first bought, and we want to know what has she been interested in lately. And there actually is some fascinating stuff here. You see some 23s. These are purchased within the last, with this year. And there's a couple more down here that are the last day of 2022. So those are also compelling. It's also interesting to note that she latched onto Fox Factory 6 years ago. And Yeti is 3 years ago. So, and Five Below. I did find it interesting that in the interview, she is talking more about the stuff that she's been trimming or not accumulating in the interview. So a little bit of talking one's book, but we'll forgive her for that. Okay, so let's take a little bit closer look. Here is basically a a quick summary of some of these companies. These were the ones that she was talking about in the Barron's feature, and maybe it was some of what we were talking about earlier, Ken. The talk of the companies in the S&P 500 on CNBC or anytime out in the media. You're going to talk more about. You're going to be inclined to talk more about these type of companies than the ones up at the top. And that could be part of it. And these are all covered by Value Line and Morningstar and the analyst consensus, so you get a feel for those. But those 5 up at the very top, she sees as being capable of continuous, sustainable growth going forward. So I thought we'd take a little bit closer look at them. What on here appeals to you, sir?
Well, I still like Yeti. 2 of my clubs own Yeti. It's a personal holding in my wife's IRA account, and I think that all you have to do is go to a big audience and ask how many of them own more than one Yeti thing, and you don't get as many hands as you think you might get. But the people that own at least one are very, very solid about the product. And then you talk about what would you do if you lost your insulated mug or whatever, and the response almost unanimously is, I'd go out and buy another one just like it. So I really like the product itself, and it seems to bear out. Morningstar and the ACE both seem to think it's undervalued, significantly undervalued. 12%'s not bad for a small to mid-sized company as far as total return is concerned. And the ACE number is certainly compelling at 17%. So
Yeah,
I really do like Yeti.
Pretty good profile left to right. I actually bought this fairly early after the IPO, and then I was switching some accounts around, and I was going to repurchase it, and I forgot to. So now I'm going to have to discipline myself and get back into it. Now, I don't have a whole lot of familiarity with the names at the top of the page, and that kind of gets my interest, especially when I see, things worth exploring. These are fairly large numbers. So are these. And these are pretty decent discounts at Morningstar. Now, they can get kind of confused about the early stage companies, so take that with a grain of salt. But there's some interesting stuff here. So let's take a look.
I also think it's fair to say, Mark, that the quality rating for a lot of these really small early stage companies, I'm not going to say it breaks down, but it has certain parts to it that can move very dramatically quarter to quarter or year to year. It doesn't maintain, these really small companies don't maintain a quality rating like a Johnson & Johnson or even a Yeti or an Etsy or a Five Below might maintain. And I'm not adverse to looking at companies with quality as low as 20 or 19 as are on this list right here. You just have to know what parts of the quality are lacking, and does there seem to be a reasonable chance that it's going to increase in that particular area. The quality is just a little bouncier, I guess, for these really small companies.
Yeah, and as you're studying a company, a lot of times it will be the brevity or the lack of a track record counts against them. Let's face it, you start with the financial strength of a B or a B plus or worse, and if you actually execute and perform, that improves over time. So if you can envision what that means to your company, more data, more information on the trend will actually help your earnings stability, the predictability of your earnings. So yeah, all those things can actually improve, and that's of course what you expect from a company that starts out down in that lower range. So let's go ahead and
I wouldn't put up with a quality of 20 from a good solid mid-sized company, but a quality of 20 from an emerging small company, I think can be dealt with a lot of times. So I don't want you just to cross it off the list
Right.
because of that quality.
All right, a little bit of housekeeping here. The name of this company is DocGo. I had never heard of it. How about you, Ken? Have you heard of it?
No, never heard of it
Okay,
before.
this all here, all of these dots should not be here. There's no data. So the first year of data for a projected return is recently. Same thing here. I should take those out before building the graph. So we have very limited data. Again, this is one of the higher quality companies amongst the ones we're looking at. But again, a short track record. Again, keep in mind these are forecast. So they have a fairly short track record. It's not the ugliest picture. One of the things that I notice in looking at this, just again looking for glances of things to notice, is the earnings trend is up and the price trend has been pretty stagnant. That suggests possible opportunity, absent any other information. And we do see fairly decent mid-20s to teens returns on a company like this. I didn't know anything about them. I think it's a demographic play. These guys basically provide EMTs and send people out to do house calls and healthcare in your home or place of business. And then they also have a fleet of ambulances and EMTs and nurse practitioners and all that kind of stuff. It's actually a fairly interesting study to look at. So I would take a closer look. I mean, one more short story. One of our best friends is a veterinarian. He was in a multi-vet practice about 10 years ago, and he left the multi-practice, left his partners, and while he was building his new facility, he actually rented a big RV. I keep thinking of Breaking Bad and giggling a bit. He got this big RV, and he did a veterinarian on wheels and did nothing but house calls, and it was very successful. I've often asked him, why didn't you just find a way to keep doing that? Because he basically went to the dogs. So, gone to the dogs. What do you see here?
After our meeting last night, Mark, we went out to dinner with one of the couples from the club, and their son-in-law has been trained as an EMT, an emergency medical technician, to ride around with first responders, and he's going back to school. It's being paid for completely by a doctor's office that he's working for right now. He's going back to school to become a physician's assistant, and the dream after he finishes the physician's assistant course in a couple of years is to do exactly what this model is talking about right here, where he would be the person riding in the mobile device, and the physician would have a number of these mobile devices out in the road, and he'd be in his office where he could do video calls, he could do different types of chats with the patients, and offer services that are basically kind of concierge services for people that don't want to pay concierge prices.
Couple other things here to look at. They have as much cash as their total liabilities. That's kind of interesting. The other thing that you might do as you're doing an industry study or any type of a comparison is try to come to some judgment as to where does this plateau at? What does this look like out here based on other companies, in the similar business area? Because that's going to dictate, what your outlook or what the potential is for a company like this. So DocGo, DCGO. It's the first one. Here's the second one. This is a miniature Oracle / SAP type company. And again, ignore the zeros. I need to get more awake early in the morning, I think. So just take those out. But this is another fairly interesting company, again, in the mold of SAP or Oracle, and showing a whole lot of strength. Again, this is a pretty good picture to build on. And there is kind of a teaching moment here. If you leave this one in, if you pull up regular data, this is one that you want out as an outlier because it's such a partial year here. So you want to watch for these type of conditions. So you definitely want to leave that one out of the trend. If you left it in, you think you're looking at a 27% growth rate up here when it really is probably high single digits. How about this one, Ken? Does this one ring a bell with you at all?
Not again, not at all. I don't know anything about the company. Not as interesting to me as the one prior, but still, it's it it's this kind of early stage company. I guess we should say, Mark, that we've noticed an awful lot of early stage companies that will show profitability for a year or two and then dip back underneath into negative profitability. That's losing money, and then come back to profitability and stay profitable. So these haven't had a chance to make that first kind of burp of life. And we don't know where they're going to go because we only have one good year of data right there,
Mm-hmm.
but they're certainly interesting candidates.
Yeah, and I'm going to amplify and build on what Ken just said. Right now, this is the expectation for a light. If it comes in down here, so that this happens, that will be very, very ugly as a shareholder. So you want to make sure you understand that when investing in these type of companies. This price bar will definitely chase that down, and the price bar will look something like this. Okay. Third company, I guess I should have known this one. This one's actually been around for quite a while. Bumble. How about you, sir? You know about Bumble?
No, not at all.
This is electronic dating and matchmaking.
Yeah, Bumble's claim to fame is it turns the transaction on its head. Bumble is a place where the ladies go shopping. So
Yeah.
it's meant to. It was founded. I think the founder was a veteran of maybe even Tinder, something else.
Yeah.
And found that the ladies' experience dealing with a lot of, if you will, spam or unwanted calls was an issue. So everybody pays, but it's the ladies that make the first move on Bumble.
Yeah, and
So
it
those
proved
of
to be
us
a
that have been
calmer
married for
environment.
53 years don't know anything about this kind of stuff, Mark. So
I, I know. I mean, Matt's completely right. I think boy, you want to talk about logical in terms of placing this responsibility in the lady's hands instead. It's probably a whole lot better off. My wife is the ultimate wannabe matchmaker, so maybe I get some advice from her. You know, what's not to like with what you see here, as long as these guys are really taking care of the business, and it's it's it, it's definitely worth taking a closer look at. Hired teens on the projected returns, and wish them a lot of luck. I actually have 2 or 3 family members, one married and one engaged, that actually went through that electronic online discovery thing. So it happens.
we should make the point, Mark, that none of these last 3 or 4 stocks would be considered core.
No, no, we're definitely into early stage and something else.
Yeah, non-core.
Same thing is true here. This is a company kind of like Jack Henry, only operating specifically within the property and casualty insurance stuff. And so they have a lot of solutions in that area. Again, very early stage. Um, they're beginning to demonstrate, again, if they pull these years off, uh, that's an attractive picture, operating at approximately 10% for a growth rate. So I can see what uh, Rena is seeing in these companies as she goes after them. Okay. Anything else on there, Ken, that reaches out?
I'm noticing that they've taken the time to put AI on the list, so that should assure them of a
That
big market cap right
that,
there, you
that should
know?
that should move the price bars a little bit up. So just with that mention. All right. I think we've got one last one. And this is a good one. This is right up your alley, Ken. I didn't know about this company. I'd seen it mentioned a few times. It's based in the United States and Canada, but it's all of those companies on the left. These guys are a serial acquirer, but we've actually had our house painted at least one time by the CertaPro painters. These are kind of, this is all that fixer-upper stuff that my wife watches the Magnolia channel while I'm sleeping, and I know that you and Natalie seem to find sport in watching these renovation programs.
Yeah, we really are kind of hooked on a lot of them. California Closets is a really big name in these flipping houses programs. A
Mm-hmm.
lot of them use use that particular company. So another really interesting one. I myself, I like the fact that there's an actual sales history and an actual earnings history to it.
Yeah, and these guys have approximately a 10% per year organic growth, so they go out and get another 5-ish% from acquisitions, and they've been quite good at it. You can see that the growth is solid. It's right in that 14 to 15% range. Notice that their earnings are also quite solid with that 1 year, and I had to immediately go out and figure out why that thing disappeared off the chart. And it's the first time I've ever seen anything like this. That was from a payoff to the founder back in 2019. So that's why that is missing a blue dot there. So I can certainly understand that, but there's much to like here, and it's probably worth following. Again, if you don't want to pick a winner between Home Depot and Lowe's and all the other companies that are in that category, maybe this is interesting. It's one that I'm going to watch a little bit closer for sure. It does also trade on the Toronto Exchange, so you will see FSV.to in some places, but this is the American Depository Receipt, ADR. Anything else there, Ken?
Nope.
All right, so we've only got a few minutes left. This is where we lick our wounds a little bit. We did mention this last week. It's something that we are guilty of being stubborn. Conviction with stubbornness, don't confuse the two. That's just a little excerpt from Charles Carlson's book on the upper left there. And then I had forgotten this, but we started the Manifest 40, which is our collection of the most widely followed companies on our dashboards back in 2005. And when we did that, the company that was actually in the pole position, leading all the other companies, was Bed Bath & Beyond. You may recall that Bed Bath & Beyond was kind of a poster child as a quality company in the community back around the turn of the century. And in fact, there's a mini chronicle right there which shows you a very strong quality rating, and that price chart looks just wonderful. And a lot of us held that in our portfolios. Your thoughts, Ken?
Well, I held it for I don't know, maybe half dozen years until the company started to kind of stagnate. It didn't drop precipitously, but it did move into a position where the growth just wasn't there anymore, and wasn't something that you could point to and say that's something that's consistent. I think you have one more graph here that kind of shows it falling right there. It goes,
That's just the quality, and the reason I put this up
yeah.
here is this is the good news part of this discussion about being stubborn or patient. Again, it was in the Manifest 40 back in September 2005. It was in the number one position. In fact, I believe the quality probably starts up here somewhere. And what is fascinating about this, again, I don't think 2,000 people huddled on over the phone and decided to make an exodus from this company, but it disappeared from the Manifest 40, meaning that it was no longer among the 40 most widely followed companies in fairly short order, really. I mean, we probably still have 28 of the original 40. This one dropped completely out. And that's interesting to me. And I don't know, Ken, maybe we chew on this even a little bit more. Maybe we think about, when a company breaks through a previous level. I don't know. All I know is that is a community consensus in action. And I'd like to understand better, how is that driven?
Well, we've played around a lot, Mark, with the concept of a significant drop in quality has mind-blowing focus on what's going to happen with the company long term. And what we've always kind of been stymied on is the word significant. Is 100 down to 80 significant, or is it 90 down to 70 that's significant? They both seem the same to me, 20 points, And yet I think that I get a different feeling when we move below 80 down into 70 and then even below 70. So that I, I think we're onto something. Just defining how we're going to use the numbers to tell you when you have something that maybe has become something that you don't want to hold anymore. And maybe drawing attention to the chronicle is a good first step. We don't draw enough attention to that chronicle on a regular basis, and maybe we should.
Yeah, and then maybe we need to make it a little more granular. I was actually going the other direction. I don't know. The moral of this particular story is this was good news. Our community basically walked away from this stock well before much of the price damage set in. So here's the bad news. This is one of our ultimate exercises in being stubborn. That's my opinion. I don't know if you share it or not, Ken, but
Absolutely. Yep.
uh, we had 5 positions in the round table that we took. In fact, the first night that we selected Fossil, Ken and I actually ended up at Fossil kind of from 2 different directions. The audience agreed with us, so we took 3 positions in Fossil back in June 2012. And then a couple more positions were added. And just like I've kind of noted on here, somewhere in this time frame, somewhere around here, uh, Ken, you gave a very eloquent explanation that this company was really in trouble thanks to the Apple Watch. And we didn't listen. And I think that's probably uh, a qualifying candidate for being a little too stubborn. I do think it's kind of interesting that we bailed out, and we bailed out in a pretty nice way. I'll show that to you in a second on a more detailed price look. But again, I think you should take credit. I'm pretty sure you talked your club out of selling it back in that time.
I uh, out of selling it.
No, you talked the company into selling Fossil because of the Apple
Yes,
threat.
yes. The one club that owned Fossil, we moved out of it as we talked about Apple, and it came down to the fact that who were you going to believe, the Apple stock that you owned or the Fossil stock that you owned? And since we owned both of them, and Apple was performing magnificently at this point, why not move the Fossil out of the portfolio?
Yeah, it took us quite a while to come to our senses. Here's the price chart in a little bit more granularity. Uh, I will take credit for being involved in the decision not to sell it here, but to sell it here. We had a price jump up there over a couple of months back in late 2017, early 2018, and we bailed in January 2018. The other thing that kind of jumps off there, we have talked occasionally about being mindful of death crosses or golden crosses, and this one just kind of screams out. You know, as you were scratching your head in this zone here, maybe it is time to be mindful of this situation here. So it's just something to think about. And the other thing I do find a bit fascinating because you hear so much about it, this long-term moving average, the 60-month, it's a 5-year trailing average that you see swooping down here, and they taught the technicians that actually follow prices more than the fundamentals. We'll talk about that actually being a resistance line, and you can almost see the stock price deflecting or reflecting off of that longer term trend. So kind of one of those self-fulfilling prophecies, Ken.
Yeah, I'm getting a little bit antsy when you telling me that these lines know what they're doing. So I'll just sit
All
here
right,
quietly.
we'll
Okay.
just leave with that. All right, so we'll leave you with a couple of quotes from one of Ken's favorite authors, Morgan Housel, about patience versus stubborn. And what it really comes down to is stubbornness being the idea of ignoring when the facts have changed or conditions have changed. And the Apple Watch was definitely quite a change that needed to be factored into what you thought of with Fossil. So we were not being patient in the case of Fossil, in my opinion.
Well, and Mark, I think that this these paragraphs right here are particularly germane as we begin to grapple with this whole concept of AI. I think we're going to be inundated with AI for the next 6 months or more. And I think it behooves us to decide for ourselves what AI is and what it isn't. And I think that's a much more sophisticated discussion than a lot of the folks are making at the moment. I don't think AI is the savior of anything. I don't think it's necessarily the destroyer of anything either. I think it's another tool in the toolbox. But I also think that there's a lot of folks smarter than I am that we need to consider and listen very carefully to what they have to say, so that we can make decisions that put us on the right side of this, what most folks are considering to be another big change in our lives. I mean, who would have ever guessed the change that little cell phone would have made if we were back in the late 90s?
Mm-hmm.
And yet today, they're strapped to hands, and you got sore thumbs from texting all the time. And who would have ever guessed in the late 70s going into the 80s that the computer would have gained such traction and become something that we couldn't live without? So AI is just merely the next step along the road, but I think we have to define what it is, and we have to understand the capabilities of whatever they mean when that big amorphous they out there says
Mm-hmm.
AI.
Yep, same thing. Agree completely. A lot of it is hindsight. Again, not being flippant here, but it makes sense to always continuously challenge the assumptions that you make. I think many of our disciplines stand the test of time very well, but you always have to be willing to question and avoid falling into a morass of confirmation bias and that sort of thing. So, one last slide just to sum up the thing. And this is the one that I sent to you, Matt. This article here actually goes through, and it kind of sounds like winning in bets and Annie Duke talking, even more than this particular slide. Being willing to question and learn about evolving and changing conditions is
Yeah,
kind
and
of a
he
big part
cites
of
some
it.
of the same sort of root sources that she did. So that's not coincidental, but it's when two people who've gone through, if you respect their writings and their thinking now, if they go back to the same source, you have to pay attention to that.
Good stuff. All right, we'll go ahead and wrap up. We are going to be working within the next month on this topic of looking at the infrastructure and energy production and some of the concepts that were brought up in George Gilder's book, along with the answer to the question, or at least attempting the answer to the question, two questions. What does Warren Buffett see in utilities, and might GE actually end up being a powerfully good answer to some of this challenge? So pretty wild when you think about it. All right. We do archive all of these presentations on YouTube. Please feel free to share with friends and family. These are free. We put all the roundtables and all the bull sessions on here so you can go back and catch them. And one last slide about being unimaginably imaginable. I think I have one more. Just our reminder that our multi-decades approach does pretty well over time. All right, Ken, anything else?
No, it's been a nice. I like this slide, Mark. I just like the way it looks. It'll give us a lot of space to put good things up there in the sky. So good slide.
Okay. Let's go ahead and sign off then and keep trudging along. Hope you enjoyed our deeper dive on the small company fund that we featured here. And by the way, this was from a podcast, Millennial Investing. If you want to actually go listen to Raina Hinaway, and you can actually catch that.
And Mark, we did get the answer to the movie you were searching for from our audience. It was called The China Hustle.
The China Hustle, yeah. That's also a good thing to keep in mind. If it'll actually engage and strengthen your skepticism. All right. Well, thank you very much.
Good night, everybody. Good afternoon, I should say, everybody. Yep.
All right. Take care.
Bye-bye.